The truth is that all this time that they allegedly were manipulating the silver market, silver was going down all by itself. The U.S. dollar was very strong in the period 1982 to 2022. And you didn't need to manipulate something that was falling all by itself. I'm not suggesting that there wasn't short-term manipulation in the market. There's short-term manipulations in all markets. Markets as large as the euro-dollar market, the U.S. Treasury market, have been proven to be manipulated in the very, very, very short term. Once we began to lose control of the interest rate in 2022, surprise, surprise, the dollar weakened and gold and then silver got stronger. There will come a time when silver will be manipulated up. I remember the 1970s when the overnight raids in the silver market were long raids, not short raids. I remember that very, very, very well. The same players, I would suspect, would build very, very, very large and very long variegated futures positions and then pile into the physical market because the futures positions were leveraged so that the overnight boost in those days in the price of gold and silver would produce outsized gains in the physical market. The same technique that they used in the period 1982 to 2022 on the short side. No difference. The time will come again. Understand that the manipulators take markets in whichever way is the easiest to take it. They're completely agnostic. And when it is easier to manipulate precious metals markets up than down, that's what they'll do. When the natural direction of the markets is down, but the preponderance of punters is on the upside in futures markets, the manipulators happily fill the mooches. In their words, when it's easier to fill the mooches long, that's what they'll do. The shortage of physical silver could be prevented in the future. You may recall 1987, when the silver price shot up as a consequence of Warren Buffett announcing that he owned 20% of the world's above-ground supplies of silver. An interesting thing happened at that point in time. We didn't know how much physical silver was in India, but the price of silver doubled in U.S. dollar terms, and the Indian rupee fell by half, which coincided with either a flood or a drought, I forget which, and the need that the Indian peasantry had to sell their silver, which was up fourfold in their terms, to feed their children. All of a sudden, supply came out of nowhere. The flow of silver, which had been from Dubai to India, reversed, was from India to Dubai. And we had more silver we could shake a stick at, of course. The people who were hurt by that blamed the manipulators, but the manipulators were really the Indian peasantry. Now let's get back to the base question. The silver manipulation works like this. The futures market trades some days 100 times, some days 200 times the amount of physical silver available for good delivery. Almost all of the contracts roll off worthless or are rolled over. Those are the two things that happen. Occasionally, the markets get unbalanced and syndicates of shorts go way short the silver market, borrow physical silver, which they blow into the market, take a loss on, and cover their shorts as the physical market, the tail wags the future market dog. Remember, too, that when some newsletter writers talk about a short squeeze, that's not the way futures markets work. What happens if there's a real imbalance in futures markets and there's a failure to deliver? We saw this in the tin market 2 years ago. Is the guys who run the exchange, who, by the way, are the dealers, and the banks, say, too bad, so sad. We're halting trading, we're going to set a price, and we're going to cash settle. That's what happens. If you think that you're going to catch the silver banks way offside in a market that they control, I got a bridge to sell you. Now, I'm not trying to say that in the event of a silver squeeze, that the long side wouldn't make a lot of money. I shouldn't say this. It is alleged that in my youth, I constructed quite a few short squeezes on the Vancouver Stock Exchange. And it is said that I caused some short syndicates in the equities markets really, truly religious experiences. And I suspect that at some point in time, old habits die hard. When the silver market is stronger than the shorts believe, that they will get trapped. Well, they won't get trapped. They'll get squeezed. And they'll probably lose billions. But the circumstance where they'll be called in for physical metal won't happen. The exchanges will halt the market. and the exchanges will set a clearing price, and it will clear in cash. No, human nature is the same. Silver bounces back from oversold bottoms in anticipation of the gold move. The gold move happens, then the generalist investor comes into the precious metal space. Leadership changes from gold to silver. Silver goes crazy. And towards the end of the silver move, people take it to absurd heights. They pile on. That always happens. I suspect we're going to have a real good precious metals market this cycle. Likely better than the one we had in 2000 to 2010. Likely better than the one that we had in 1989 to 1996. I think we're going to have a real move in precious metals, and I suspect that the blow-off top in silver will be one for the record books.
Let me start by saying this. If you've been around resource markets as long as I have, 5 decades now, you learn that human nature never changes. Markets might change. Governments certainly change. But human nature is eternal. Greed and fear drive everything. And that means the way to truly profit over a cycle is to do what human nature tells most people not to do. Buy what's out of favor. Hold it patiently. Sell it when it becomes absurdly overvalued, usually to the same people who thought you were an idiot 5 years earlier. Now I get asked all the time, probably more times than I care to count, about silver manipulation. It's become this rallying cry for retail investors, YouTubers, newsletter writers who are absolutely convinced that shadowy forces are constantly beating down the silver price. Look, I'm not here to defend bullion banks. They are absolutely opportunistic. But let's separate reality from mythology. The truth is that for decades, from roughly 1982 all the way to 2022, the US dollar was in a massive bull market. Real rates were mostly positive. US capital markets were the envy of the world, and that naturally pressured precious metals. You didn't need manipulation to make silver go down. It went down all by itself because the opportunity cost of holding a sterile asset like silver was high when you could be earning 6% in treasuries or 15% in junk bonds. Now, is there short-term rigging in futures markets? Absolutely. Markets as large and liquid as the Eurodollar futures, the Treasury bond market, have been caught manipulating prices over days or weeks. Traders at major banks have literally gone to jail over it. It's not a tinfoil hat theory. It's human nature. If there's a way to game the system for short-term profit, someone will try. But here's what most silver conspiracy buffs miss. Once we lost control of interest rates in 2022, when inflation finally overwhelmed the central bank's fantasies, suddenly the dollar started to weaken. And surprise, surprise, gold went up. Then silver followed. The natural order of things resumed. I tell people all the time, there will come a day when silver is manipulated up. I remember the 1970s very clearly. The so-called overnight raids in silver back then were long raids. Big players would build enormous long futures positions, pile into the physical market, and use the leverage from their futures to spike prices. It's the same mechanism that worked on the short side from 1982 to 2022. Just flipped. These guys are totally agnostic. They don't care about ideology. They care about whichever way the market is leaning, so they can extract the most money with the least resistance. It's also important to remember the sheer size of these paper markets. On many days, the futures market for silver trades 100 to 200 times the actual amount of physical silver available for delivery. Most of those contracts don't result in anyone taking home shiny bars. They either expire worthless or get rolled over. The real volume of metal that would actually change hands is tiny compared to the financial bets stacked on top of it. Sometimes these markets get out of balance. Syndicates go massively short, borrow some physical silver to dump on the market to drive prices lower, and then cover. That's the game. I've seen it 100 times. And yes, sometimes the tail wags the dog. The futures market forces a reaction in the physical price. But let me also kill a myth dead right here. People love to talk about short squeezes on silver. They dream about catching the big banks offside. The reality is that if a futures market blows up, like we saw in the tin market 2 years ago, the exchanges themselves step in. The guys who run the exchange are the dealers and the banks. If delivery fails, they halt trading, they declare a cash settlement, and they set the price. It's not like catching some Reddit short on GameStop. Now, am I saying you can't make a ton of money on the long side if silver takes off? Of course not. In my younger, more mischievous days on the Vancouver Stock Exchange, it's alleged, I emphasize, alleged, that I orchestrated a few squeezes of my own. Some short syndicates found religion very quickly when we pinned them to the wall. So I absolutely expect there will come a time when silver runs harder and faster than anyone expects. And some over-leveraged shorts will pay dearly. But you're not going to bankrupt JP Morgan and force them to deliver bars they don't have. They'll just settle it in cash.
Less volatile than I expected. I have to say, I've always wondered how the arithmetic was going to work. And I've always been concerned, having experienced 2008 as an example, about a fear-driven liquidity squeeze. The 2008 liquidity squeeze happened with our nation's balance sheet, at least our public balance sheet, in substantially better shape than it is today. And I'm afraid that if a liquidity crisis of that order of magnitude were to occur today, the ability that the Fed in particular would have to deal with it is much, much, much more constrained. As recently as 1981 or 1982, in the U.S., federal debt was about 30% of GDP. Now federal debt is about 130% of GDP. In 1982, the net present value of unfunded liabilities in the United States was about 1 times GDP. Now the ratio of unfunded liabilities to GDP is about 4 times. And I continue to be concerned about, first of all, the arithmetic around our reliance on the government. And I continue to be concerned about what happens in society if greed in financial markets turns into fear. I'm also concerned about the growing acrimony in the U.S. and other places. I'm concerned that people have been politicized enough that they believe that they're entitled to the fruits of other people's labor. I'm afraid that white people now feel like they're being crowded out of entitlement markets by black people. I feel like black people consider that whites have taken unfair advantage over time. I'm concerned about our concern about immigrants. I'm concerned about the rising tide of anti-Semitism. I think a lot of this has to do with politics. If people believe that they're entitled to the fruits of other people's labor, if they get crowded out of access to other people's labor, they blame the other people rather than the fact that they should have been self-reliant. And so I'm concerned about that. But, you know, I'm a 72-year-old curmudgeon, and I understand that some of it might just be myself. I've always been optimistic about my ability to thrive. I've been optimistic about many of my friends' ability to survive. Sometimes I thought they might need my help, and sometimes they have. And I should probably be more optimistic about society. You know, we've talked, Dunnigan, you and I, about the fact that Pareto's law says most people are good. There's only sort of 4% of the population that are programmed to be problem units. Maybe 1% of the population that are programmed to be really, truly hostile units, which means that, you know, we need to try to hang out with the 96% who are good people, maybe worry less about the 4. Sadly, too many of the 4 are elected officials. And, you know, that is, of course, problematic. You know, I remember, sorry to answer this ad nauseum, but
no, actually, you're going about where I was going to go in the end anyway, so you just keep going.
It's a very interesting question. I remember when I was about 16, cataloging all the woes that were in front of me to my grandfather, asking him, you know, what I thought I should do. You know, Vietnam, which I wasn't particularly interested in. Anybody who grew up in California, as I did, I was explaining this litany of woes to him. My grandfather started laughing. He said, you know, son, my generation had some challenges too. We had World War I, which wasn't pretty. We went from World War I to the Great Depression, and we went from there to World War II, which ended with the atomic bomb. You're going to get through this.
So let's keep going from where we left off. We were talking about opportunity, how volatility and crisis, for the prepared, are not things to fear, but things to exploit. If you're holding gold and silver as insurance, congratulations. You've insured yourself against the monetary stupidity of the world's central bankers. If you're holding some of the right mining equities, even better, because that's where you can turn insurance into serious capital gains. Now, people often ask me why I like mining equities if I already believe the underlying metals will do well. It's simple arithmetic. In the right phase of a bull market, mining equities act like leveraged warrants on the price of the commodity. Take silver. Let's say it's at $35. If it goes to $70, that's a double. But a reasonably run silver miner, with costs that are mostly fixed, might see cash flows go up 5- or 6-fold. And if they're disciplined about paying down debt or buying back shares, which granted is a big if, the equity price could move 10 times. That's the type of asymmetry that keeps me in this game after half a century. Of course, the key is buying the right miners. And that means knowing how to analyze their recycle ratios, their cost structures, and, most importantly, their management's history of capital allocation. Remember what I've said for years. In the mining business, more money has been lost in the boardroom than has ever been stolen from drill rigs in the bush. Let me unpack that a bit. We talked earlier about recycle ratios. How much new resource a company can find or buy with the cash it generates from producing an ounce or a pound today. That's the ultimate sustainability metric. If a company can use the cash flow from mining an ounce of gold to discover or acquire more than one new ounce, that's accretive. If it can't, it's consuming itself. Agnico Eagle is a classic example. They're not the biggest producer in the world, but they're arguably the best. Their capital discipline, their per-share focus, not just bragging about how many millions of ounces they produce in aggregate, is why their stock commands a premium. By contrast, there are dozens of companies that have chased ounces for ounces' sake, destroyed balance sheets, diluted shareholders to oblivion, and still don't have any meaningful production growth to show for it. Now let's pivot to silver miners. I think this is going to be the most explosive part of the market in the next few years. Why? Because the setup is classic. We've had a decade of underinvestment. Silver demand is rising not just because of monetary demand, but also industrial demand, photovoltaics, electronics, medical. Meanwhile, new primary silver mines are as rare as hen's teeth. The world gets about 70% of its silver as a byproduct of lead, zinc, and copper mining. So if you want new silver, you either need a surge in base metals projects, which we're not seeing, or much higher silver prices to justify new primary mines. When the generalist investor crowd comes into precious metals, and they will, they'll look at gold first. Then they'll say, silver looks cheaper. It always follows gold. And they'll pile in. The silver price will run. Then they'll look at the silver miners, which will be trading at absurdly low multiples to cash flow, and they'll push them to nosebleed valuations. This is exactly what happened from 2003 to 2011. We're seeing the early innings of this already. Some of the big silver miners, like Pan American or First Majestic, have started to move. The juniors, your little 50 cents or $1 names, they're still asleep. But that's typical. They always lag. Then they explode. And remember what I said earlier, human nature doesn't change. Toward the end of a silver run, you always get absurdity. In 2011, people were drawing lines on charts showing silver going to $500. That's when you sell to them, by the way. You buy now, when the average investor still thinks you're a crank for caring about silver. Now, I know some people still obsess over manipulation. They want to believe that if only the manipulation ended, silver would instantly go to $200. I understand the frustration, but let me tell you a story from my own younger days when I was more prone to mischief. It's alleged, and I use that word carefully, that I orchestrated more than one short squeeze on the Vancouver Stock Exchange. We'd find companies that were heavily shorted by syndicates, and we'd methodically accumulate every share we could get our hands on. Then we'd quietly pull certificates so they couldn't be lent. The next time the shorts needed to cover, there were no shares to buy. Prices exploded. Some of those shorts found religion real fast. But here's the difference. Those were tiny, illiquid equities. The silver futures market is a global behemoth. If you think you're going to force the LBMA or the COMEX to physically deliver silver they don't have, you misunderstand how these markets work. They'll just halt trading and cash settle. That's exactly what happened in the LME nickel fiasco. The exchanges exist to protect the system, which means the banks, not you. That doesn't mean you can't make a fortune. You just have to know the rules of the game. In a big silver run, the shorts will get squeezed. They'll have to buy back contracts at much higher prices, and yes, they'll lose billions, but they'll pay it in cash. The price will still spike, and if you're long physical silver or quality miners, you'll make a killing. Just don't expect to bankrupt JP Morgan. Now let's broaden out to the big picture again. The reason I'm more bullish now on precious metals, and especially on mining equities, than I've been in 20 years is because of what I see happening at the macro level. Government debt is exploding. In the US, we're running deficits north of $2 trillion a year, even with an economy allegedly at full employment. That's madness. In the next downturn, the deficit could easily widen to $4 trillion. Unfunded liabilities, Medicare, Social Security, veterans benefits, are another 4 times GDP. There is no mathematical way out of this except through inflation. The politicians will never choose austerity. It's political suicide. They'll keep printing until the bond market revolts. And even then, they'll try to print more, which is why I think gold isn't just going to $4,000 or $5,000 an ounce. I think over the next decade, we could see levels that today sound absurd. $8,000, $10,000 an ounce. Not because gold is getting more valuable, but because the currency in which it's priced is losing value faster than anyone can mentally adjust. Silver, by its nature, will overshoot even more. It's a tiny market compared to gold. When global capital tries to squeeze into it, the move will be violent. You'll have days when silver is up 10% or 15%. You'll also have days when it's down 10%. If you can't handle that, you shouldn't be in the game. Now let me tell you why I'm still optimistic about all this. It's not because I trust politicians or central bankers. It's because I trust human ingenuity and individual initiative. Despite all the government bungling, most people are decent, hardworking, innovative. Pareto's law applies. Roughly 96% of people are good units. Only about 4% are problem units, and maybe 1% are truly hostile to civil society. The sad part is that a disproportionate number of that 4% seems to get elected. But the rest of us just keep building things, solving problems, and finding ways to thrive. When I look at my own life, all my greatest financial successes came from seeing what the crowd didn't see yet. In the late 1990s, I was buying uranium when it was despised. I bought platinum and palladium when people thought car emissions regulations were a passing fad. I bought oil sands acreage when the majors were writing it off. In every case, the narrative was this will never work. And in every case, the people who did careful analysis and had the guts to act were proven right. I believe the opportunity in gold, silver, and select mining equities right now is of the same magnitude. Maybe bigger because this time the fiscal math is completely unsustainable. You can't fake a balance sheet forever. So here's my advice. First, educate yourself. Spend less time reading sensationalist headlines about manipulation and more time understanding cash flows, all-in sustaining costs, reserve replacement ratios, and jurisdictional risk. Second, build a portfolio that matches your temperament. If you're the sort who panics when prices drop 30%, you should own more bullion and fewer juniors. If you can stomach volatility, the juniors offer life-changing upside, but only for the right personality. Third, stay liquid enough to take advantage of volatility. You'll make your best buys on days when everyone else is puking shares into a panic. That's when you step in. It's hard emotionally, but that's why it works. And finally, keep your perspective. This is just another cycle. It will end one day and we'll start another. But people who position themselves properly will come out of it vastly wealthier, both financially and in terms of personal confidence. I'll leave you with the same wisdom my grandfather gave me when I was a worried 16-year-old cataloging the world's problems. You're going to get through this. Keep your wits, keep learning, and keep investing wisely. You won't just survive, you'll thrive. And frankly, that's exactly what I think is going to happen for people like you. The fact that you're watching, listening, reading means you're already ahead of 95% of the crowd. The future is uncertain, yes, but it's also full of opportunity. So get prepared, stay engaged, and take action. The next decade could very well be the most rewarding of your life.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.